Option contracts are priced using mathematical models such as the Black-Scholes or binomial pricing models. Since options are derivative contracts, an option price is derived primarily from the underlying asset it is associated with. As the price of a stock rises, the more likely it is the price of a call option will rise and the price of a put option will fall. If the stock price goes down, the reverse will most likely happen to the price of the calls and puts. Also known as premium, option prices are composed of the sum of its intrinsic value and extrinsic value. Intrinsic value is the price difference between the current stock price and the strike price. For example, let's assume that you own a call option on a stock that is currently trading $54 per share. The strike price of the option is $50, the option premium is $5. Because the market price is above strike price, the strike is in the money. Only in the money options have intrinsic value. Because the stock price is now $4 more than the option strike price, then $4 of the $5 premium is comprised of intrinsic value. The another dollar of the $5 premiums is comprised of extrinsic value. Extrinsic value is also called time value. It is directly related to how much time an option has until it expires. The more time left until expiration date, the more extrinsic value. For example, an option with 3 months to expiration will have more extrinsic value than that of an option with 1 month to expiration. Well, the time value decays exponentially. A general rule is an option will lose 1/3 of its value during the first half of its life, and 2/3 during the second half of its life. Extrinsic values decline to 0 at expiration date. Another factor that affects extrinsic value is implied volatility. Implied volatility measures the amount an underlying asset may move over a specified period. Implied volatility is a dynamic figure that changes based on activity in the options marketplace. Normally, if the implied volatility increases, the extrinsic value will increase. As you will see in the option chain, the price of option, mark price, is always equal extrinsic value plus intrinsic value. In the money, strikes have both intrinsic values and extrinsic values. However, out of the money, strikes only have extrinsic value and no intrinsic value. To learn more about stock investment and trading, please subscribe to my channel. Also click on the bell to get notification to catch my latest videos.